Good morning. Thank you all for joining us for today's coffee talk. My name is Sean O'Brien. I'm president of QuickGrade. I'm going to quickly move to the stars of our show. First up, Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, good morning, everyone. Thanks for joining us again today on this glorious fall Friday. My name is Steve Huntington. I'm the director of analytics here at QwickAnalytics. I've spent my entire career working with community banks in everything from M&A, strategic planning, capital advisory, model design and maintenance. And I've been working with Sean here at QuickRate for a little over a decade.
All right. Thank you, Steve. And welcoming back our dear friend, Paul Allen. Good morning, Paul. You want to go ahead and introduce yourself?
Good morning, Sean and Steve. My name's Paul Allen. I'm a shareholder with Saltmarsh, Cleveland, and Gund. I work out of our Orlando office, and I have the distinct pleasure of spending 100% of my time working with financial institutions. So I'm a sick puppy. I love banking and love bankers. So glad to be with you.
Well, thank you, Paul. We're thrilled to have you. I know our audience of banks here today are as well. So just a reminder, we will send out a link to today's recording that will contain the slides we used. We will also, as we have the last couple of months, continue with our polling questions. If throughout the presentation, and we've already had some come in, communicate us or drop questions in the chat feature or the Q&A box, and we will monitor those and take them either in the midst of the presentation or certainly at the end. All right, so let's move into our polling questions. Again, we thank you for having shared those with us. Let's see. I don't see my polling questions. Hold on a second. Uh-oh, we may not have polling questions today. Why is I not? We may not have polling questions today. Let's see.
Yep.
Oh, here we go. Let me see if I can get them come up here. Here we go. All right. We're in my toolbar. All right. So first up, what concerns you most over the next 12 months? This is one, again, we've asked the previous months. But again, kind of just seeing how this may or may not have changed over the last, since we last asked. So with all these, we'll just give them about 30 seconds and then we'll show the results and move on.
Hey, Sean, I don't see any possible response here for NIL money in college football as my greatest concern, how it's going to change the game.
I think
coming
that
from
one,
little Wake Forest, we don't have a whole lot of NIL money to go around.
That might be liquidity, so. Steve. Might be liquidity.
Right. Way to look at it.
Right. Okay, so we'll go ahead and end this one. And we'll share them. So again, liquidity kind of remains at the forefront, but I will say I think that's down from last month. Credit quality at 23%, AOCI adjustment at 11, and loan demand at 13. All right, so let's move to the next question around the economic conditions assumption. Do you expect to change your economic conditions assumption in the fourth quarter? Yes, with a higher loss factor. Yes, with a lower loss factor. No change expected. So again, we'll give this just 30 seconds or so. Okay, well, this is kind of where we were, I think, pretty much last month, but 76% of you aren't going to expect any change, 2% with a lower loss factor, 22% with a higher loss factor. So thank you for those responses. Next up, a loan loss reserve. Will you be increasing your reserve this quarter? Just a simple yes or no on this one. Okay, about evenly split. Share those results. 51% said no, and 49% of you said yes. So Thank you. Let's move to the next one. We added a couple extra ones this time, so I'm going to move a little quicker than I normally do. Are your actual loan loss reserves higher than the required level? Quote unquote, unallocated reserves. Yes, but only slightly. Yes, unallocated between 10 and 15%. Yes, unallocated over 20%. No, GL reserves approximately equal to the required reserve. So this will be, again, one of the topics we discuss with Paul. We always appreciate his input on this as an auditor. So again, we thought we'd kind of tee it up here with the polling question.
This is anonymous, right, Sean?
That's exactly right.
Okay.
You're right. Okay, so we're going to end this one. This is I think this is interesting. So 36% said yes, of less than 10% of required. 18 between 10 and 15% of required. Yes, unallocated over 20 of 15% and 31% right on the money. So certainly volatility around the number is certainly interesting, and again, a kind of a practical reality of what many of us are going through. So all right, thank you for that one. Just a few more here. Again, going back to liquidity, are deposit outflows slowing or increasing during the past quarter at your institution? Or no change is I guess is the third option there. Okay, and that one, share those. So 47% say it's slowing, 14% say it's increasing, and 39% see no change. So again, I think it's encouraging to see 47% slowing. But I think we all understand the pressures that still kind of feel like they're out there around that. So all right, I think we're down to our final two questions. Last two. Have your external auditors or regulatory examiners reviewed and made recommendations about your CECL calculations? I know many of you are in the midst of those right now, but we wanted to kind of get a broader sense of how that is being experienced. Okay, let me go ahead and end that one. So 25% yes, reviewed, but no recommendations. 31% said yes, reviewed and made recommendations, and 44% said no. So again, thank you for the results. And again, we'll include the results of the survey questions in the email we send likely on Monday afternoon or Tuesday morning with the link to the recording and the slides. All right, final question around internal audit. Whoops, here we go. Hold on. Can I get to that one? Oh, I gotta stop sharing. Here we go. Have you had your internal auditors or consultants perform a CECL model validation or review? Were there any significant recommendations from that review? So the response is yes, reviewed, but no recommendations. Yes, reviewed and made recommendations. No. So again, appreciate everyone's participation and patience with these polling questions. Again, I think they're interesting to us. We hope you find the information and the responses helpful to you as well. But again, we also felt a lot of these were top of mind questions that many of you are going through. So we'll stop this one and share the results. So yes, reviewed, but no recommendations, 16%. Yes, reviewed and made recommendations, 22%. And 62% said no. So again, fantastic. Thank you very much. We'll include those results. Let me get out of here. And let's get to the slides. So I think one of the things what we have Paul here, we asked him just to kind of share what he has been hearing. Steve and I also what we've been hearing, but in particular, we were curious and thought it'd be interesting for you to hear kind of what Paul's hearing. So what we've done is just kind of put some key topics and questions that we know are being discussed. And I think at this time of the year, I think model validation is starting to become, again, resurfacing as a, I don't want to call it an issue, but just kind of the next step in the process. And so, Paul, how would you, again, just kind of discuss or describe the model validation process and any major issues that banks might want to be considering?
Well, the whole process of model validation for CECL is very similar to what we're already pretty familiar with interest rate risk and liquidity modeling and so forth. So once again, management has the responsibility of selecting a model and a model vendor that's appropriate to the bank's risk profile, type of lending, size, and so forth. And so once management has selected the model, then management is working with the model vendor. The model vendor has a program or a model, but they are dependent on management giving the appropriate data. So garbage in, garbage out, that aspect of, well, thank you. That's a good picture. If you look at the box in the middle, that's the model. Management is responsible for getting the correct data into the model, making sure that the mapping works and so forth. And then half of the data in the model probably is real data, real life, actual data, and about half of it is assumptions. So putting the correct assumptions, not the default assumptions, but the assumptions that are appropriate to your bank and your loan profile is a responsibility of management, making sure that the vendor's getting that information and putting it in correctly. And then when the models run, just from a governance point of view, there has to be some validation or verification that the output, the results and the reports that come from that model run are getting to the correct person. And so when we talk about model validation, it's really everything on this page. And management is responsible for having someone independent of the function. So someone at the bank that doesn't run the model, or hiring an external firm to do that for you, but they're going to do some verification of the data input, tying balances back to GL and loan trial and so forth. They're going to be looking at your corporate governance minutes, what assumptions were approved, whether they're reasonable for the bank. They're going to be testing or verifying that. And then they're going to be testing how the results get used and who sees the results. The vendor, really, for the most part, the vendor is the one giving like the math or the processing information so that you can verify that. So often there's some kind of a SOC report or information from the vendor. So management is responsible to make sure that someone actually does that, working with the vendor, but independent, verifying that the data is going in, the assumptions are going in, and the output's going out. And then asking the vendor show them that when you put 2 + 2 into this, it always equals 4. So how does it process the data? And so the verification, first of all, has to cover all these aspects and has to be done by someone that is not involved in the process. So we can't ask the vendor to hire someone else and provide all this for us. That would be not, the vendor's not independent, but the vendor can provide a lot of information, as y'all have, in terms of helping management show that they've looked at the processing inside the box, but management has to remember the things that are outside the box as well. And so typically model validation occurs when you first put a model in place, when you change models or change key assumptions or processes, or when you change models. So it doesn't necessarily have to be done every year. Most banks will rotate that in and out, but most of us are implementing this for the first time. So there's probably an expectation by regulators and others that the bank will have some form of a model validation, sometime within a reasonable amount of time of adopting CECL. So an awful lot of banks are doing that in this first year and a half. Does that make sense, Sean?
Absolutely. That's perfect, Paul. Thank you. And so we'll have another slide here that, kind of Paul touched on. It's in here. So we'll get back to that in a second. But then, again, kind of moving on to the other topic again, which was one of our survey questions, was just around the whole notion of the quote unquote unallocated reserves. And we saw in the responses, a lot of the banks, well, maybe not material, which again is an operative word here with
Hey,
unallocated.
Sean, can
Yeah.
you see, we just got a chat question in
Yeah.
that was specific to what
Sure.
Paul just mentioned. So maybe we should, if you take a look at that.
Yeah.
I think that was
Yeah.
that the question, Steve, about does the vendor's SOC report
Yeah.
satisfy? Yes, just like your core processor provides a SOC report on your core processing, that the vendor selects someone that's independent of the vendor and provides that so that everybody doesn't have to hire someone to go and look at the vendor. If you can imagine, if for a core processor, we'd have, if they have 3,000 banks, they'd have 3,000 auditors go in and ask the very same question. So typically vendors will hire an independent firm to do a SOC on their processing, and that satisfies the 2 + 2 = 4. It doesn't satisfy that your data and your assumptions and your outputs are done, because that's your part of it. So the SOC report basically says, if your data is put in correctly and the assumptions are put in correctly, if you give us 2 + 2, it will always equal 4. But you still have to validate periodically that your data is going in and your assumptions are going in. So it's something you work with the vendor in a very similar way to what's normal and has been for years when we look at our core processor and say, a lot of controls are related to loan trials and reports and so forth. So we turn to the core processor and we say, give me a SOC report that you've paid for and you provide to your users by an independent firm that's looked at our processing. So that satisfies part of the model validation, but not all of the model validation.
And one way I like to look at it is, and being in charge of and working with that SOC report that we provide each year, the process that we go through with that external auditing firm to provide our SOC report, they look at where our data is coming from, right? They validate with us that we're getting publicly available data from call reports, that data is that we're getting that's publicly available is accurate, and that it's going properly into the tool, the math is working properly and meets industry standards. All of that part of it is provided as part of our SOC report. But anything that's outside of the realm of historical publicly available financials that we're providing as anything that's an assumption, right? If you're plugging in 930 values that you haven't filed a call report yet, but you're doing a 930 CECL right now, or ACL calculation, you're typing in values that are outside of what we provide because it's not publicly available. And any of the assumptions, anything that you're assuming, right? All your WARMs, all your look back periods, all that kind of stuff is 100% within your realm. We certainly have opinions and we can discuss what we think, numbers that we tend to see, but that's all part of your part of it. And we provide, but the SOC report does, kind of validate that the publicly available information is accurate, is properly going into the tool, and is being properly processed and calculated based upon the assumptions you plug in to get to the final value. Just another way of saying it.
But you're still, even if they say that you're getting the call report information, we're going to look individually at your bank and trace information from your GL and loan trial and call report into that report. So there's again, model validation has several different foundation stones you have to touch, part of which, but not all of it, part of which is what the vendor provides in their SOC type report.
Fantastic. Thanks, Tim, for that question. So again, kind of moving on to the unallocated reserves. So Paul, maybe again, just share your thoughts on the, kind of the acceptance or the acceptable threshold of unallocated, and maybe even just a brief description of what technically an unallocated, is.
Sure.
Or might be.
And I just want to go back historically. We've always had this concept of unallocated reserves. Before CECL, we had the incurred method. We used that method to try to estimate future losses. Let me emphasize the word estimate future losses. And so, we would use different spreadsheets and so forth to come up with an amount that appeared to be an indicated or required reserve. And then management had to determine whether they thought that was reasonable or not, and then book that in the general ledger. And it was very, very common that, there might be a slight difference between what's in the GL. You might round to thousands versus the model being to dollars and things like that. And so when CECL first started coming out, a lot of people would say things like, well, unallocated reserves aren't allowed under CECL, to imply they were before. But under GAAP, you are required to fairly present your financial statements, which includes an estimate for reserves on loans. And so now we're using the CECL model, but we're still using that model as a support for what's in the general ledger. And there's probably going to be lots and lots of times when that CECL report may not exactly match the GL. And so as an auditor, we're always going to look at that and say, is it materially different? Why? Is there some reason or thought process that management doesn't believe that the model has enough in there? Sean, I was just mentioning in Bank Director magazine, there's a great lead article about the credit storm. Several bank CEOs said, we don't know what's coming down the pike, and we're probably going to lean on more reserves than less. And so that's a discussion with your auditor. If you have a reserve on the GL that's different than your model required reserve, there's going to be a discussion about whether that difference is material and reasonable, and if any difference or unallocated reserve would result in the financials not being fairly stated to an investor. So, there's many times in all of my career that there's been slight differences or some differences between them. If that's because you're being sloppy with your GL, that's going to be a problem. If that's because you're using it as a cookie jar to set aside a little for the future, that's going to be a problem. But just to set expectations, it's going to be fairly normal that the GL is rounded or slightly different than the actual required reserve in the model. But I would just point out to everyone, let's all calm down. We're trying to estimate the future. And so whatever model that we use is not precisely perfectly accurate for the future. It's an estimate. And so, I would just ask everyone to use some common sense there. You may find examiners or auditors that just fiercely believe that GL should be exactly to the penny to whatever that model requires. And I will defer my judgment to others. But I just would point out that the underlying concept of using the CECL model is no different than the FASB and GAAP that was required under the incurred method. It's just a different model. That's all.
Yeah. So. Yeah. Thank you. And again, I think many on this call have heard me say tongue in cheek, we're playing the same game with a new set of rules, right? I mean, we really just changed the way we were trying to estimate that reserve. And I do think we had someone commented that the CPAs want unallocated at 40% or below. So yeah. I'd say that.
And Sean, I think that many firms will probably internally set their own thresholds of what they generally can live with, whether it's an absolute dollar amount, whether it's a percentage of the required reserve, which is probably the most common way of looking at it. In other words, if I require a $1 million reserve and I have on my GL 1,000,001, that's usually considered a 10% variance. It's just the difference divided by the required. So most firms will probably continue to set those internal thresholds, but again, it's a concept of materiality. Is it materially different or not? So, and it probably leads us into the next one as well. That CECL asks us to set a reserve for unfunded loan commitments, and most common response I ever get is, we've never lost money on a commitment.
Right.
Okay. But nonetheless, CECL has required you to consider that. So we have a great, as we say in the profession, a diversity in practice. Some people have just ignored that and have zero in that. I think that's a little bit dangerous, because I think it just sort of is like thumbing your nose at the auditors, examiners.
And a lot, or you will see in just a little bit that that's a higher percentage than we expected to see.
Yeah, so there's got to be some way of doing that. And so probably the most common concept for that is to take your unfunded loan commitments, break them into the same collateral codes where you have loss factors, estimate how many of those unfunded loans will fund, and then apply some kind of a loss factor that is comparable. In other words, if I have a 10% loss, well, that's too high. 1% reserve factor for a portfolio that I have $1 million, and I expect traditionally that I usually close 80% of my loan commitments. A lot of banks will take that 80% times the unfunded, come up with an expectation of funded, and then apply the loss factor for that loan collateral. By the way, when you do set that loan commitment up, if and when those loans do fund, you reverse it out of the loan commitment and you book it into your regular ACL. So, you're not like booking that and then forgetting about it. It's constantly going to be changing.
Yeah.
And that happens
again,
automatically with our tool. As part of our tool, that happens automatically, right? If you come in the next quarter, after a loan has been funded, right, your starting balance for the unfunded commitments will be less whatever that commitment was, and your loan balances will be greater whatever the loan ended up being, and so the balances will shift automatically in the tool, and then the same math will apply to whatever remains or what's been added to the loan portfolio.
That's right. So
we did have a question.
Excuse
me. Good morning, Jeff. What would you suggest a bank do with excess reserves amount above their threshold, Paul? I think going back to the unallocated.
Well, I mean, that's when you have to sit down with the auditor and come to grips with the fact that if you do have those excess reserves, the auditor is essentially saying your financials are not correct. And so management's going to have a discussion with them about and internal, that's a time to look in the mirror and think about your reserve level. If your reserves are higher than your outside trusted advisor is saying, and you can't really get to a situation where you can reconcile yourself to that, you might want to question whether you need to reverse that reserve. There is no provision for putting that reserve somewhere else, like in other liabilities or something like that. That is clearly not appropriate. So your extra reserves stay in the ACL. They are part of the general ledger balance for your reserves. The question is whether or not your general ledger is too high or not, and that's something that I would always encourage a robust discussion with your examiners and so forth. You can't really put that anywhere else on the balance sheet. I see a little question in there about putting it somewhere else in the balance sheet, but that would not be the only way that would go into the equity section is if you reverse that reserve, right? You would reverse it through provision, and therefore it would end up in retained earnings. But you can't you can't kind of hide that reserve anywhere else in the balance sheet. That reserve is a contra asset to the loan portfolio.
Or if you have more of a what we call the unallocated than your auditors are comfortable with, is it a question of going and then allocating it to an existing qualitative factor adjustment, right? Instead of having the model suggest you need 1 million and you've got 1.2 on the books. Well, where's the other? What's the reason for the other 200,000? Going and suggesting a reason for the other 200,000 in the form of another or an increased qualitative factor adjustment for economic conditions, or what have you, to then sort of allocate that unallocated. So it matches.
Yeah,
closely.
so I want to be careful there, Steve, that we don't have any auditors or examiners on the call, because that would pathway lead you to turning the knob until you get the number you need without regard to actually setting those assumptions.
You'd have to defend the allocation. So certainly.
You would have, if you have too high a reserve than your model requires, and you still think that reserve is required, it's certainly grounds for you to go back and determine whether the model assumptions are really appropriate or not.
That's what
but we can't just sit there and turn the dial.
No, it's not for reverse engineering. It's for reconsidering. The suggestion was reconsider the assumptions that go into the tool and see if they're still appropriate. Because if you really believe you need 1.2, but your model's only telling you need 1, then why do you believe you need 1.2? And if there's a legitimate reason for it, it's a change in assumptions of the model.
Yeah. So, we just have to understand that model is only as good as, the assumptions and data put in there. So, I trust, there's a lot of bankers that I trust their judgment. They can't necessarily tell me why their reserves need to be there, but they are. And I usually go, that's probably the right number. So let's go back to the model and make sure that the model is working the way I expect it to. But again, one of the points we want to make is that there's always a concept of materiality, and I don't think anybody ever expected someone to run a CECL model and just say blindly that model result must be my actual reserves going forward. There's nothing that the model has a lot of math in it, and it could imply a level of precision that isn't really there. Let's all keep in mind, we're still estimating and looking at and predicting the future. And so if your model's not showing you what you feel like you need in the GL, like Steve said, I strongly encourage you to go back and look at those assumptions and make sure that the model is reasonable based on what you know about the bank and so forth.
That's great. And so their question came in, and I just wanted, before I answer this question or pose it to you too. So again, I think what we've seen again in practice is, really a 3-path route for most of our banks. One is they simply have no balance in the unfundeds. 2, they apply some basis points to the entire lot of the unfunded. And 3 is the path that Paul described, and is similar to what we have in our CECLSolver, where essentially we're looking at the probability of funding, applying a loss rate, and multiplying that. So Stacy, to your question on the unfunded topic using a funding rate, that's pretty much what you're doing. So your assumption where you expect to fund from calc to calc, and then that amount is applied by a loss rate, that is a perfectly defendable and reasonable approach to the unfundeds. But again, I just wanted to share in practice, that's kind of what we're seeing are really those 3 different paths.
Yeah, and the concept of at any time of the measurement, you're basically looking at your unfunded, deciding how much you think will fund, applying a loss factor, booking that reserve, and in effect, every month you reverse all of that and run that same calculation over and over again. So the model's just doing that for us, but that unfunded reserve is only on the loan commitments that remain unfunded. Anything that gets funded should be taken out of that pool, and that reserve is in essence reversed to 0 and set up again every accounting period. Obviously, we don't actually go through that reversal, but that's the effect of what we're doing.
Absolutely. That's great. Thank you, Paul. Next topic is just around impaired loans. We're starting to see in small supply. Banks starting to have some, loans that are getting a little bit of hair on them. So, I think, again, practically, Paul, the question we get is, when do you break those out? How should I pool them? How should I think about those individually assessed loans? What do you see from your banks?
Yeah, so this question is really around a sort of a current trend of banks that may have 2 or 3 impaired loans or 5 impaired loans or whatever, and having a question of, well, does that create a new pool? So should I pull them out of the regular pool and then have a pool called impaired loans? And in concept, that would be okay as long as the impaired loans are all of the similar risk profile. But usually that's not the case. So that's why it will probably be, as we go forward, perhaps out of the auto loan portfolio, you might break your auto loan portfolio into components. But there's not really a risk profile that just says, for any kind of a loan, once it turns impaired or meets the criteria that we used to use for impaired, it wouldn't necessarily say that any of those loans would be the same. So if we pulled out a C&I loan that we wanted to individually evaluate, and we pulled out a CRE loan that we wanted to individually evaluate, it's hard to imagine a scenario where it makes sense to pool those 2 loans, because the factors that would create losses would be different. How they would react in certain economic conditions would be different. So generally speaking, once management is identifying a loan or several loans that have significantly different risk profiles than the pool, they're pulling those out. We're loosely calling those our impaired loans. We realize there's been a lot of change in the accounting for quote unquote impaired loans or TDRs or anything like that. But once again, it really should be breaking out loans that you want to evaluate individually. And then the question becomes, would you ever pool those loans that you broke out? Well, only if they are probably similar collateral, similar risk profile, similar terms, likely going to be influenced by the same economic conditions. So while we're getting that question, Sean, I'm not expecting that a lot of people will actually end up pooling loans that have been pulled out for individual evaluation.
Agreed. Yeah, and I think again, in our tool, you can pull them out and individually assess them. But I would agree. I don't think we'll rise to the level of pooling them.
Yeah, I mean the health of a credit is simply one characteristic of the risk profile of that credit, right? Whereas and there's so many different ways you can look at that. So we think the way we think of pooling loans is, if you have a call report, right? Our tool starts with call report segmentation because that's the information that we have publicly available to us. If you have one call report segment on your portfolio, which really comprises 2 very different types of loans, sub segments that perform differently, behave differently, but than the other, let's say, sub segment of that call report, that is when you create a new pool. Whereas if you just simply have a handful of loans within a certain call report segment that are underperforming, those are individual assessments, not a pool of simply underperforming ones that all otherwise are identical to the rest of the pool.
Absolutely.
Great. Okay, so the next topic is just, I think this is really one that is timely. I also think, just as a point of reference, in hearing Jeff Gear from the OCC, and I think I've mentioned this on previous coffee talks, kind of the primary chief accountant with regard to CECL at the OCC, throughout the summer when you'd hear him speak, he would remind the banks and the audience that the E in CECL was for expected, and that as it related to Q factors or economic condition Q factors, he would hope that banks were ahead of adjustments rather than behind potential losses. So, Paul, as you think about the economy potentially, as you referenced the bank director article, heading for potentially maybe a bit of a downturn, when should a bank start thinking about adjusting their economic, Q factors, and or how far out, or just how should they be thinking about that?
Yeah, so that would be yesterday, Sean. If you just think about the headlines that probably crossed your laptop or on your phone screen this past week, we've had a number of economic conditions, indicators, perhaps news that's coming out. The Federal Reserve, we keep thinking they're going to just drop rates here real quick, anytime. But certainly this week we got a pretty clear message that there's a lot of concern about the unemployment rate, consumer confidence indicators, that would probably lead you to believe that, the Fed, while can't predict that future either, the Fed is probably pretty likely to follow the consensus view that there's maybe one more adjustment up, and more importantly, that there's not a lot of indications that once they are satisfied with inflation, they'll drop rates quickly. So probably all of 24, maybe into 25, we may not be seeing the kind of rate increase, but we may not also likely see reductions. And so when we think about our economic conditions, for example, on commercial loans, as I mentioned, Sean, earlier in that credit storm article, there's some $700 billion of non-resident commercial loans that are repricing or maturing in the next year or so. 400 billion of that is at banks. The rest is at insurance companies or credit unions or other entities. And so, you have to be thinking right now, what will my commercial customers, how will their business look as we go forward? There's a lot of, economic conditions that, even though employment looks real positive, there's other things that don't necessarily look great. If inflation continues, or at least continues at some level, will they be able to pass on those price increases to their customers when their loans reprice? Many of those loans, were at 3 to 4% and will be repricing, certainly 5 to 8%, something like that. I mean, quite a bit of an increase. And as we work through post-COVID, we've had a lot of discussion about office spaces in the past, but a lot of those office leases already had a term that they had to play out, and they're starting to come up for renewal. And so what will that look like? What will retail look like? So I would strongly encourage management teams to be looking at the economic factors, because, just in the last week, if you just open up your business news feed and just start looking down the discussion, there's some significant economic factors that you can look at right now and determine how 24 and maybe into 25 will look. But this isn't rocket science, John. This is reading the headlines and revisiting your economic conditions on a dynamic basis. So I certainly think that I wouldn't, if I was running a bank, I would not want to wait till 12/31 to revisit my economic conditions for the next year. I would be doing that now.
Well said. Yeah, and I think, obviously it's unique for everybody, but I think, as you mentioned, right, I think the level of refinancings, a lot of times where these commercial real estate loans were capped, where they were at cap rates 4 or 5 years ago, are dramatically different than today. So it is a little bit of a new world. We did have a question come in. We have a client with a high ag loan population. Almost 100% of the lines fund during the year, as with the crop cycle, then pay down. Client is concerned about funded versus unfunded reserve going back and forth each quarter, and optics from the regulators. Any thoughts on this fluctuation each year, or how this unique mechanism will work?
if you're a public bank, I would think that your auditor probably wants to see that reserve level go up and down during different quarters, because the SEC has historically always wanted those fluctuations to be reflected in the income statement, even though it causes volatility. From our regulatory friends, they would probably say, just make sure you have enough and keep it in there. So I think that, you're going to have to really dig in and look at how those things fund and whether those unfunded are really expected to be funded during any particular quarter, and determine how sensitive earnings volatility is to that bank. Again, if you're a non-public bank, you probably can book one reserve for the whole year and leave it level during the year. If you're a public bank, I think that there's probably an expectation that just like your actual risk goes up and down in a quarter, that probably you would have some earnings volatility during the quarters that would reflect to that. But again, we'd go back to materiality. So if that real fluctuation quarter to quarter is there but minor, you may not get any criticism whatsoever for just keeping the same level during the whole quarter of what you expect, the whole year, excuse me. But if it's material and you actually are having that risk go up and down in a quarter and you're public, it becomes more sensitive that your earnings sensitivity or volatility would match your risk volatility. I'm sorry to say that it's not the happy answer, I don't think, Sean.
No, but I think it's a couple things though, I think that are spot on, Paul, right? That the expectation versus a publicly traded bank versus a privately held one is one that runs, there's a lot of that just runs through this whole CECL analysis. This one, obviously, it's even more, kind of highlighted. But I think that's, those are the practical realities of whether you're publicly traded or privately held. All right, another question came in regarding the Excel tool that Steve built. So for audit purposes, we previously presented how we could use the Excel app. We will, if we have time, there's slides in here for that. So if we get to those, we will again go ahead and demonstrate that.
Yeah, I can do that real quick at the end.
Yeah. Thank you, John, for that. Michael, we had one FDIC finding. They want to see more formal way of estimating Q factors. Is there a way to provide more structure to an estimate? Paul, what would you say best practices for giving structure, to a bank's Q factors?
Well, some of this is very, very soft and very judgmental. So I think one of the things that you can do is on perhaps a quarterly basis, supplement your model results with maybe a couple of pages of discussion about why management believes these are appropriate. In other words, what was your thought process? If you can document your thought process, certainly automotive loans are much more sensitive to retail type of or individual consumer related economic conditions, and commercial loans are subject to other economic conditions. So you don't have to write a book, but I would probably suggest that it's a good practice to write a couple page narrative, and you would update that each quarter about what your thought process was on arriving at a qualitative factor. And you could do it for every qualitative factor, or you could do it for what you consider the key ones. But unfortunately, it's very difficult for you to show a mathematical calculation of what you use for the Q factor. These are judgmental things and estimates. So I think to bridge the gap is to help the examiner or auditor understand what your thought process was. And many banks will write a quarterly narrative that goes along with the model result and kind of walk someone through what was our thought process, what were the key assumptions, and how did we arrive at this range of a qualitative.
Sean, can I share my screen for 1 second just to point
Sure.
something out related to that?
Yeah.
Unshare.
Yeah.
So I wanted to make sure whoever asked that particular question was aware of one of the additional tools that we have as part of the CECLSolver. Let me share
Yeah.
my screen. Is that popped up? So
It has.
typically, in our tool, we have a Q factors page where it allows you to plug in, a different adjustment for each segment of the portfolio, for each different type of qualitative factor adjustment, and add custom adjustments, and then add some basic notes on it. But this is, this provides basic structure for the adjustments, but not kind of how you came upon them, right? And so we do have in our CECLSolver resources what we call a Q factor determination support matrix. That's a lot of words, but it's an Excel file that looks like this. And it was just we wanted to give a little bit of more structure as an option, as an alternative for our users. So if you haven't seen this, it's something you might look into. It provides a little bit more framework for whether, looking at each segment of our portfolio, do we see changes in, significant changes, moderate, minimal changes, no significant changes, or less risk in this particular segment for this particular adjustment. And it just kind of provides some framework where you can make a lot of notes and tweak some of the assumptions here. And it could be helpful in defending and adding some structure there. So if you haven't seen this tool, it's a great, and what you would do is you could use this tool and then just simply take the results of it and then plug it into the interactive tool. Once you're done with this, it'll calculate, a total adjustment here, or an adjustment for each segment for each Q factor. And then you can bring it right here to the interactive tool. And it just provides you more flexibility with what you consider, what is a moderate increase in risk? What does that mean? 10 basis points, 30 basis points? And you can kind of define that there and then, go over that with your auditors and examiners. So hopefully if you haven't seen that tool, that can be helpful.
Yep. And I see some banks use both of those so that they would have a brief narrative that talks about management's expectation about, economic conditions and so forth, and then support that with that kind of an individual worksheet showing the calculation. So, unfortunately, there's not one independent metric that proves or completely supports your qualitative factors. They are highly judgmental. So anything you can document is really where you want to go
and you take that Excel file and do it's your Excel file after you start with it to do with as you please. So if you want to calculate things differently and use different levels for moderate or extreme or whatnot, you tweak it, you save it, and then you just can update it on a quarterly basis by copying the tab over and then updating it and saving it. You certainly don't need to keep the format that we have there. It's just a template that you can work with.
Yeah, and I think, again, part of the idea was that, and that's actually one we use in our small bank in Illinois. The idea is that at least it gives you a consistent framework every time from which to kind of pick up from where you left off last quarter. All right, Paul, maybe just again, you kind of covered this very well earlier, but just again, anything to add here about those three, major points of model validation and oversight?
No, I just would encourage anyone that's, if you're going to do a quarterly validation, you basically want to comment or show that you've stepped into or looked at each one of these. These are the major components of model validation.
Fantastic. Thank you. So we touched on that slide. Internal controls, again, I think these were some of the points you made during that discussion. So these are here more just as a reminder for everybody of things to consider as they're modeling their internal controls. Paul, anything you want to add here?
No, the larger the bank, the more formalized you would have to document these controls. And I will point out to everybody on the call, these internal controls are not unique to the CECL model. They're unique to all the models. So your anti-money laundering model, your interest rate risk, your liquidity risk, all the models you use around the bank, really at some point you have to think about, are there internal controls, making sure that model is working as we expect it to.
Perfect. Thank you. Okay. So as Steve touched on earlier, we had him go into the stats and come back with some numbers on, what are actually, banks doing. And so Steve, I'll let you take these slides since you did the work on them.
I wish I could have done a blind poll of Paul and Sean to ask them what they thought these numbers would look like before they saw them here, because they were a little different than I had anticipated. But so we went and I just kind of looked at the entire industry of community banks, the 4,300 of them that exist in the United States, which is it's a pretty liberal definition of a community bank for sure. But as of June 30th, and this hasn't changed very much between March and June and the early numbers we're seeing in September, but over 54% of all community banks reported $0 in ACL for unfunded commitments. Meaning over 99% of community banks have some level of unfunded commitments, and 54% of those still recorded zero allowance for credit losses for that portfolio of unfunded commitments, which means the median reserve level for unfunded commitments is 0.0%. The 75th percentile for ACL percentage on unfunded commitments was only 27 basis points, and the 90th percentile was 61 basis points. And that's, again, with a liberal definition of community banks. A lot of that is coming from the larger community banks. So if we just looked at community banks under $1 billion, so none of the $1, $2, $3, $5, $7 billion larger community banks, those numbers get even higher. I think about 64% of community banks under $1 billion had zero recorded ACL for unfunded commitments, and the 75th percentile was still only like 19 basis points. So interesting and a little bit surprising how high those the percentage of community banks that aren't reporting anything on the ACL for unfunded commitments. If you think that's surprising for held to maturity securities, and this is something we always talked about in our polling, about 38% of community banks around the country have some sort of a portfolio of held to maturity securities. Of that, and while only 6% reported any sort of ACL for the securities portfolio, which means that 85% of banks that have held to maturity securities are reporting zero ACL on that, which does not surprise us very nearly as much, actually, which means that the 75th percentile is still zero, and the 90th percentile is only 3 basis points on the securities portfolio for ACL. So I just wanted to give you guys some reference points, versus the ACL on loan portfolios, your regular loan loss reserve, which is right around 1.25% median. So not too different than it's kind of been historically, right?
Steve, Maria had a question. Is that for banks under $1 billion, or is that the under 10 billion number?
Which number?
Median ACL number.
It is the same.
Okay.
It's 120. If you take out the $1 to $10 billion and you're only looking at community banks under $1 billion, it's 1.25%. If you add in the bigger community banks, 1.24. So very little difference.
Very little difference. So, again, I think, I think as Steve said, right, I think we were all surprised at the level. Well, we knew a lot of banks were not funding the unfunded. As Paul mentioned earlier, it does kind of expose you, to almost in some ways invite some, I don't want to call it criticism, but it's probably going to invite a response, or an inquiry. Why you
have you properly considered it, right?
Yeah,
and yeah,
exactly. So for what it's worth, the HTM, as Steve discussed, for most banks, most community banks, this is kind of a non-issue. So that one's a little less.
And that's because of the government guarantees around most of the held to maturity securities. There's no real credit risk, interest rate risk, maybe credit risk on the held to maturity securities. Relatively uncommon, very uncommon for community banks.
But and then the median ACL, I'm actually, it's a little higher than I would have even thought. I mean, it's not surprising. I think that's where, most banks aim to be between 1 and 150 basis points. But for the median to actually be there, I was actually, I will say I was somewhat surprised. So, but that's good to see. I think it's actually good, healthy reserve. Just a reminder, some of the enhancements, we won't cover those. We'll get to John's question about the add-in tools, just because he asked it. And again, this is probably going to become something that we'll continue to talk about, try to demonstrate even more. But Steve, do you want to just do a quick discussion on this again?
Yeah, you can leave the screen up for just a second, and then So the idea for this tool was for more, help from an auditing standpoint and from a model validation standpoint, and from being able to kind of spot check specific calculations all the way from cradle to grave, right? All the data that we get, there's a lot of data that comes from the call reports, is all the historical, right? The historical charge-offs and recoveries and balances for every segment of your portfolio going all the way back in time, right? 15 years quarterly, that's 60 periods. There's, 20 categories of loans, and there's charge-offs and recoveries and balances. You can see there's a lot of numbers there that go into it. So what we wanted to provide, certainly that's not something we'd want to display in an interactive environment, or the internet would blow up. So we found a way to build an Excel tool which would aggregate all that data, show you all the raw data. So every single quarterly period of data coming directly from your call reports, unadjusted, unmodified, and then intermediary calculations that go from charge-offs and recoveries on a year-to-date basis, which is what the call report provides, and net charge-offs on a aggregate basis, right? And net charge-off ratio. So there's some steps with little math to get to that. It shows all those steps and then provides the final calculations that will match perfectly to what you see on the historical tab for the interactive tool. You can change warms, you can change look back periods, you can see it all recalculate on the fly exactly as the interactive tool does, but with the ability to dig all the way back to every single call report value that you filed. So let me share my screen for just a second, and so I can show you kind of how that works. Hold on, I'm gonna find it here again. All right.
And Steve, just so you know, we are on the hour, so
yep. I'm always quick, Sean.
I know.
So in the interactive tool, if you go to the CECLSolver resources, we have a new historical loss data and calculation tool. When you click on that, it's going to say, hey, have you downloaded the add-in before? If you've never downloaded the add-in, you do that here. Once you have the Excel add-in, this is how you'd get that actual file. When you open up that file, this will be all zeros, and it'll pop up and it'll say, hey, do you want to update it with your data? And you say yes, and then it pulls everything in. This is the raw data. So on this tab, this is every single call report value going all the way back in time, completely unadjusted from the call reports. This is the intermediary calculations that get you from, to quarterly charge-offs instead of year-to-date, and then net charge-offs and everything else. And it all links directly to the raw data. And then the formatted sheet looks exactly like the interactive tool does. If I change a warm to 3 years, everything recalculates. If I change a look back and I say, hey, I want to change this look back to this, it works and functions the same way, and all the math works that way. It gives you some not only audit and validation tools, but if you need further customization that the interactive tool doesn't provide, you can get it here. If you want to not only just change a balance of a segment to pull out an individually assessed loan, or to create a sub pool for an acquired portfolio, if you want to go back and back it out of all the historical data, you can do that using this tool, whereas the interactive tool doesn't allow that much flexibility. So that was the purpose of the tool and how it can be used. Sean?
Fantastic. Thanks, Steve. All right. So I think we are, as I mentioned, up on the hour. So, again, I know, Maria, you had a question on policies beyond the CECL policy, just more of a retail credit policy. Paul, I don't know if you have any suggestions on that. Maria, I'll circle back with you and see what we can come up with on that. But Paul, any recommendations on just a policy draft for just a retail credit?
No, I think that most people in adopting CECL have done a separate CECL policy, and they have their regular loan policy. I haven't seen. I think we're going to have to wait a little bit before we see, a widespread putting the CECL directly into the loan policy. So I haven't seen a lot of that yet.
Okay. All right. Well, submit any final questions. If there aren't any more, just want to remind you of upcoming events. Our IntelliCredit division has a webinar here next week on the 25th to discuss how to use our application in your internal loan reviews and credit analysis. We will have a guest speaker, Mitch Moss from Outdoor Bank, joining us. We'll be back in December with the holiday. We're going to do an early one in December instead of just the last week in November, for another coffee talk on December 8th. So again, encourage you to register for those, as you will always receive a link to the recording. Mustafa had a question: do we remove the quarterly balance sheet data in the quarterly net charge-off file tab? No, I don't believe so.
I'm not sure what that's in reference to, so maybe we can reach out.
Yeah, we'll
to you
reach off
separately.
offline, Mustafa, on
Yeah.
that to make sure we've got it. Okay, I don't see any additional questions. Thank you all for joining us today. A special thanks again to our dear friend Paul Allen. Paul, thank you for joining us. Much
Thank you.
appreciated as always.
Thank
Steve
you
or
for
Paul,
having
any
me.
final comments for everybody before we let them go?
No, I just think I think we're going to have an interesting fourth quarter and an interesting 2024. So God bless and good luck, everybody. I think it's going to be a little bit interesting. So
Two factors beware. All
that's
right.
right. That's right.
All right. Well, thank you all for joining us today. We'll see you in December. And again, encourage you to join us next week for the IntelliCredit webinar. And thank you again for making the Coffee Talks so successful. Thanks and have a great weekend.
Thanks,
Bye now.
everybody.
Thank you, everybody.